risks are receding and you're suggesting some equity allocations increase, how then do you explain the underperformance of emerging versus developed markets? And do you see a rally in emerging markets equities?
Well, when we talk about the tail risks, where they've really receded have been in the developed markets. And similar on the economic side, when you think about where economic data has been turning out much stronger than expected, again, it's been developed markets. So to us, that's the reason emerging markets have underperformed developed markets to some extent, and developed markets has been where a lot of the equity gains have been concentrated. It's possible emerging market equities, can perform from here, but to me, it's more a question of what the relative performance as well as the absolute performance. From an absolute perspective, yes, there is room for outperformance. There have been policy drags in countries like China, for example, but valuations and equities in general, including emerging markets, still look pretty attractive. That's where the value is. But having said that, at this point in time, our conviction is highest, to be honest, on US equities. That's where the data has performed quite considerably over the last few months.
G3 bonds generally have less value, yet they have been overbought as a capital protection strategy. However, in emerging markets, we're seeing more money flows into debt products rather than equities. So what builds your case of going underweight debt and overweight equities?
When we look at G3 bonds, we simply ask ourselves, where's the value? And we're really not seeing any value in the government bond space, definitely, unless we build expectations of deflation into our valuation approach. So unless you expect deflation, government bonds are very, very expensive. And yes, we can argue about whether yields might rise today, in 6 months' time, in 12 months' time, in 18 months' time. But what we do know is there's almost no value in that space without the presence of deflation. The second point is, of course, to differentiate between corporate bonds and government bonds. We do still prefer corporate bonds over government bonds, and you can find pockets of value, lower down the capital structure in bank debt, for example, in some regions. But again, from an absolute perspective, it's very hard to see where the value is. And when you start looking at relative value between bonds and equities, there's clearly tons more value in equities over fixed income.
You have upgraded to overweight on base metals and commodities in general. What targets are you seeing on copper and aluminum from a medium to long-term perspective?
Well, we've upgraded commodities overweight for two reasons. One is that it's consistent with a view of a broadening global recovery. For positive on the global economy, positive on developed market equities. Chances are, base and industrial metals are likely to do well alongside, particularly when you think about, continued growth in China. But the second reason is really looking at correlations. The original reason for holding a sizable commodity position in a diversified portfolio was the diversification benefits, and we're beginning to see that come through again. Equities like to do well, but they're not going to go up in a straight line, and that's where holding a sizable amount of a less correlated asset like commodities can really help portfolio characteristics, not only returns but the amount of volatility your portfolio holds. So it's really these two reasons. We're not sort of holding ourselves ransom to any specific targets on both, but given our view of the global economy and given our basis of constructing a portfolio, we believe an overweight makes sense.